Imagine waking up tomorrow and hearing that one narrow waterway has suddenly shut down. Tankers stop moving. Oil markets panic. Governments scramble. Located between Iran and Oman, the Strait of Hormuz is one of the most critical energy choke points on Earth. Every day, roughly 20% of the world's oil supply passes through this narrow corridor connecting the Persian Gulf to the open ocean. If this passage were blocked, even temporarily, the consequences would ripple across the entire global economy. But what exactly would happen? First, the oil market would react immediately. Global oil prices are extremely sensitive to supply disruptions. If the Strait of Hormuz were closed, millions of barrels of oil per day would suddenly be unable to reach international markets. Without access to the strait, global oil supply would shrink overnight. The immediate result would likely be a sharp spike in oil prices. Some analysts predict that prices could double in a very short time, potentially pushing crude oil above $150 per barrel. That price shock would quickly spread through the global economy. But oil prices are only part of the story. Transportation costs would rise. Airlines would face higher fuel expenses. Shipping companies would pass costs on to consumers. Gasoline prices at the pump would surge across Europe, Asia, and North America. In short, inflation would accelerate globally. Energy markets are deeply connected to almost every sector of the modern economy. When energy becomes more expensive, manufacturing costs rise. Food production becomes more expensive due to fuel and fertilizer costs. Logistics networks slow down as companies try to control expenses. Countries that rely heavily on imported energy would be particularly vulnerable. Many Asian economies, including China, Japan, and South Korea, import a large portion of their oil from the Persian Gulf. A prolonged disruption could strain their energy security and force governments to release emergency oil reserves. Even major economies such as the United States and European nations would feel the shock through financial markets, supply chains, and rising consumer prices. The global stock market would likely react with volatility. Investors tend to flee risky assets during geopolitical crises, moving money into safer assets like gold or government bonds. Another critical factor is time. If the strait were closed for only a few days, global markets might absorb the disruption through strategic reserves and alternative shipping routes. But if the closure lasted weeks or months, the impact could be severe. Some Gulf countries have pipelines that bypass the strait, but their capacity is limited. They cannot fully replace the enormous volume of oil that normally travels through Hormuz. This means a long-term blockade would create a sustained global supply shock. Historically, energy crises have triggered recessions. When energy prices rise sharply, economic growth tends to slow as consumers and businesses reduce spending. That's why the Strait of Hormuz is often described as the world's most important energy choke point. A closure there would not just be a regional issue, it would be a global economic event. For now, international naval forces patrol the region to ensure freedom of navigation and prevent disruptions to global trade. But the geopolitical tensions surrounding the strait remain a constant concern for energy markets. Because in today's interconnected world, a narrow stretch of water only a few kilometers wide can influence the price of energy, the stability of economies, and the balance of global power. And that is why the Strait of Hormuz matters to the entire world.